You can never really know what really happens in the background. Once you send them the token, what they do in the centralized exchange, there's literally no way to verify.
In the world of crypto, millions of tokens exist, but getting listed on an exchange? That's where the story begins. In this exclusive episode, Ankit sat down with Maud to uncover behind the scenes of exchanges and market makers.
Most listing agreement will have some NDA. You can disclose specific condition and things like that.
Maud is no stranger to listing process and has dealt with over 30 market makers and hundreds of exchanges.
As soon as you go in the top 30 to 50 exchange, you will be asked to provide liquidity for your token. You will not be listed if you don't provide liquidity.
And the truth? Nobody talks about it.
A market maker that offers you zero fee, we do profit sharing. That profit comes from somewhere, basically comes from your community, right? Money doesn't come from nowhere.
Supported by Casper Finance, the first V3 DeFi protocol on Casper. Igra Labs, atomic programmability on a Casper block DAG. Cascade, use your Casper without selling it.
Today, I'm joined by Maud to discuss a very important topic, exchange listing and process of listing a coin or a token on an exchange. We'll get into behind the scenes negotiation that takes place, which most people have no idea that happens. Now, I did a similar chat with Junie from Kev, but I wanted to have Maud to discuss her experience. So Maud, let me start by asking, given you have seen both sides of the coin, so you worked for an exchange and now you're working for a proof of work layer one, which side do you prefer?
I mean, I honestly like better a little bit the proof of work layer one side. I like the project side a little bit more.
Right.
But on the exchange side, I wasn't dealing at all with kind of the exchange side of thing or project. I was really more on the management of the company, like HR aspect, license application, and that kind of more operational, but on the back office, if you will, of the project. But I actually really enjoy very much more the project side of things, even if it has its own challenges.
So now let's start very high level, and so what's been your experience on the project side, getting your token on an exchange, centralized exchange? What's been? Just give me a high level view first.
Yeah, of course. And I do want to preface for this question and kind of every question that will follow. Obviously, I'm sharing my experience and my perspective and what has happened for us, which obviously is just a partial perspective on the industry and the process. So of course, I'm sure there are different experiences somewhere else. So when it comes to the experience, I mean, I know there's follow-up questions, so I won't go through the entire process, right? But basically, for us, it's been, I think it really depends if you have existing relationship or people that can open doors for you into the exchange, which sadly was not our case. So we've pretty much for every exchange listing, the process was either one or the other way. If we were, it depends on the time and the market, but most of the time we have applied, meaning most exchange, they will have a listing form somewhere on their website. You will fill out a number of due diligence question, usually a lot of question, your token, your chain, some stuff about the tokenomics, obviously a legal opinion on the qualification of the token. That's something that most exchange will ask you no matter what. And because they want to avoid anything that would be a security, because usually in most jurisdictions this trigger licensing requirement for the exchange. They would want to avoid also anything that is payment token, except the big ones like of course USDT, but let's say they prefer if you fall within the utility token category, because that's usually the one that requires the less licensing around the world, even though this is obviously changing with MiCA in Europe. Usually In some cases, you fill out the form. If there's some sort of, sorry, I said, of course, tokenomics, they also want to see a lot of traction metrics. So they will look at the size of your community, And if they are interested, someone will contact you. You have to be careful. Lot of listing scams going around. So be super careful with this.
The Telegram ones, right? Lots of Telegram
Oh,
scams.
there's so many different ones. Actually, I don't know if you have a question about this, but if you don't, you should add one about my experience with listing scam, because I have a few.
Let's quickly discuss that. So, what's been your experience with listing scams?
So we've had, I mean, you have the typical one. It's really difficult because if you look at the listing process, so like I said, either you will go and you will apply on the website. In some cases, listing manager of exchange will contact you and ask you to apply. And this is usually where the risk of scam is very high, because in the business model of exchanges, they actually work a lot with what they call listing manager. They can have internal listing manager, but they also work, I think it's commission based, right? I'm not sure about that part, but they also have a lot of people who get them project to go list on the exchange, which are typically not part of the exchange. And they will do this for one or several exchanges. And obviously some of them are legit. And this is why the scams are very difficult sometimes, because that opens the door for a lot of shady people to just contact you and say, hey, I'm listing manager for XYZ. We want to list you. Apply there. And so some of them are very obvious. Like you can tell because, whatever website it sends you is not the right one. But I've had one where I had a call, and it was before you had all of those AI things. I mean, it was starting to get there, and I had a call with someone, and the entire call I was like, there's something wrong about the way they look. Like, I don't know, there was something about the video call, and I was like,
Wait,
this is
so
weird.
someone contacted you on, through Telegram,
That we're
right?
listing manager.
And you thought, right, you thought they were serious. You jumped on the call, but something was
In the call, and they suggested a video call, and it was on Google Meet. Like, it's not like I know the stuff about you going to the call and then they say it doesn't work and they ask you to install whatever thing. That's one scam. But it wasn't this one. It wasn't this. And so it wasn't an entire call where they asked me a few due diligence questions, but it was supposedly a tier one exchange. And I had done many listing before. So I was like, and I know that exchange are pretty reluctant to list layer one blockchain because it requires a lot of work and effort. We can talk about this later. So I was like, nah, like they did not ask me near enough questions. And there was something about the way the person looked in the video that was really weird. But I couldn't pinpoint it. And then they say, hey, please do apply through the website. And they had made an entire clone of that exchange website and the URL was closed, like really close. And I was like, yeah, I mean, I knew it was a scam, but I'm always curious to understand the scam, if that makes sense.
how far
It's
they
just
go. Yeah.
yeah, and they really duplicated exactly the scam, the listing form, everything. But of course, I checked. I could see it was a scam. I checked on the domain registry who owned the domain, and obviously it was completely different from the actual legit website. And so I knew it was a scam. But they really went before. It was so easy to make AI calls with a fake person that changed face, because that was like 2-3 years ago. And they basically had a completely a site that was a copy done to, you could do everything. You could connect, you could do, anyway, it was a scam. I also had a couple of Finnish teen, that was in my previous job, that run a pretty basic listing scam. But where they were good is I think they managed to hack, they managed to get access to something from that exchange. And so they were able to follow up on existing conversation. So the execution was terrible. Like if you looked at the document, you're like, yeah, no, that's not legit. But the issue, what made it so compelling was that from some reason, they knew that we had been in contact with that exchange. And so they could pick up the discussion. And if you've ever been in touch with exchanges and things, you know that sometimes discussion, it's a little bit chaotic. There's sometimes new people because there's a lot of rotation in the team. I think because there's a lot of scam, a lot of conflict of interest going on. So there's a lot of rotation. So they took opportunity in this chaos, but they knew we had been in touch. And so they kind of just went and picked up.
That's crazy. It's a very
And
sophisticated.
they actually, we
Yeah.
ended up knowing who they were because they scammed a project. Anyway, it was a whole thing. Let's just be clear. If you're not a top 30 project, Binance is not going to contact you for listing of their own accord. It's like this is not gonna happen. So yeah.
Yeah. Yeah. All right. That was a great summary of type of scams that exist today. So let me ask you this question, right? So why this topic is such a taboo topic, right?
I think it's important when you talk about it to talk about it from a general perspective, because obviously most listing agreement will have some NDA, like you can disclose specific condition and things like that. I also think that it's also an industry. I don't know.
I mean, we have like millions of projects, right? I think there was a news recently I saw that 11 million coins failed this year, just alone 2020, last year, 2025, right? So we are looking at tens of millions of tokens or coins that exist. So it shouldn't be a new topic we're discussing here, right? We're not in 2008, 2009.
You do see, on Twitter, often you see people
Yeah.
talking about the process. So it's a struggle. Again, you will have the basic due diligence. That's a lot of information on the tokenomics, the traction of your project, some technical aspect. One thing that is really important to understand is like and then you will have the terms of listings.
Which
Listing.
which I want to get into. I think I want to get into all the details and juicy bits, because those are the juicy bits, right? And they are very up for debate, right? So, but before that though, like, what is the due diligence process that they go through? Like, broadly speaking, what are they looking for from a project?
It depends. I think there are some aspects that are similar no matter what kind of exchange you talk to. Is it tier 4, tier 3, tier 2, tier 1? It depends. They're overarching one. Again, they want to look at your tokenomics. They want to look at legal opinion of the qualification of your token in several jurisdictions. Your jurisdiction, the jurisdiction where your token has been, like where it's from, and then the main jurisdiction of their client base. So, for example, in the case of Aletheum, we've had legal opinion in Switzerland. We have one in Europe, one from an Asian jurisdiction, and one from the US. So we've had really a little bit, we got covered because usually, exchange that are under a little bit less regulatory scrutiny, they will ask you for one. And as you go up, and they have a bit more regulatory scrutiny because they're bigger, usually they will want multiple jurisdiction assessment of your token qualification. They want to see traction. And as you go up the tier, a lot of them also want to time. And timing the listing is maybe the wrong word, but they want to know what you have coming.
I see.
So they want to know what is coming in the next few months that can be beneficial to the listing. So as you go higher in the tier, they will want to have the listing being around the same time as something big happening in your chain.
I see.
Whether
Yeah. To drive the volume, right? To drive the volume or sign up.
Exactly. And I think, I don't know at which stage you want to discuss this. I also want to say, like, the requirement to be listed are very, very different if you are a token or if you're listing chain and a coin. Because if you're listing a token on Ethereum, for example, the amount of work for the exchange is basically taking your contract address, enter it into their system, making an announcement. Slightly more, but that's the extent. If you're a coin of a new chain, they need a technical team that will do the integration. That's the process that takes time. Little time or a lot of time, depending on the competence of the tech team. And usually the smaller the projects, you get the more junior the developers. So if your chain is not, and even within the chain, there's a difficulty ranking, right? If you're an EVM chain, the integration is relatively easy. Like if you're pretty close to Ethereum, let's say, or a fork of another chain they already support, integration is relatively easy because infrastructure is kind of the same. But even for this, they will then need to maintain it. Once they've done the integration, they still have, every time you do a fork or a node upgrade, they have to keep it updated. So that's work for them. And then you have the chain like Alephion, which is basically the bottom of the list of in terms of complexity, because it's the more complex. If you're completely different, then they really have to start from scratch the integration. So they have to go into your tech, understand how it works, do the integration. So an advice I can give for a project like this is make sure you have extensive documentation, even if you have example of exchange integration. You know, they need like wallet functionalities. They need to be able to create sub-wallet for their users. They need to be able to easily detect deposit withdrawal. And so if you're in a complex case, make sure you have as much resources and example so that you can reduce the integration time significantly. Because that can go anywhere from, in our case, we've had some stuff as fast as 2 days to as long as 2 months.
Right. So
With
integration from
the
2 days.
same thing.
Right. That's a big difference from 2 days to
Mm.
2 months.
Because so you have to think also, so if you're a token, you basically, there's no pipeline internally, because they don't need they don't need that much resources to list you. But as soon as there's an integration that needs to go through, obviously, in addition to the actual integration time, you have to count with the availability of the technical team to do the integration. So, but the 2 months was actually from the start of the integration to the finish, but obviously the person was probably juggling multiple integration at the same time, which can explain that. But there's been integration that were low touch, where literally we gave the documentation, we never had, it was just done. And we've had some where with that exact same documentation, an amount of hand-holding and support, let's say not hand-holding, maybe that's the wrong word, but of support had to be provided to help. But it really, really depends. Do you have a junior developers? Do you have a more senior developers? Do you have a developers that is somewhat familiar with the family of your tech? Basically, that can take a lot of time. But that explains, once you've passed the due diligence, the requirements, depending on what kind of project are very different. Specifically, for example, even before talking about the cost requirements, if you are something that is going to generate more effort for them to list, the traction requirements, for example, are completely different. Like the amount of existing traction that you have has to be a lot higher.
I see.
Typically, if you're a high effort listing, then if you're a token, for a token, they can afford to list maybe tokens that have less traction because the cost for them is much lower.
Right. So if it's complex, then you better have a very solid community. Is that a better way to put it?
Yeah, but the thing is, it's a little bit the snake that bites its tail, because it's like, to grow your community, you also need visibility, because exchange, at the end of the day, exchange give you visibility, and
Yes,
it's just,
of course. Yeah.
it's hard, because it's hard to develop a big community without having access to the spotlight, which in a lot of people's mind is the exchange. But at the same time, to get access to those spotlights, you need what you need especially as a layer one. You already need to have a significantly huge community. So it's a challenge, I would say.
It's a challenge. Yeah, yeah. And, it's a weird thing, which I'm going to say now, which is, exchanges today for the new users do provide this level of trust, right? If a new user is going to Binance, for example, they already have heard this name before, right? Binance from 1,000 different places.
I mean, yeah, and if you think about it, it kind of makes sense because people basically, they will delegate the due diligence aspect. They think if you were good enough to be listed, you were listed there, so it meant that you passed some sort of due diligence, which you do. The thing is, the amount. So most exchange, no matter where they sit on the range of the spectrum of exchange, will ask you for similar due diligence background. What they do with it is very different. You have exchanges that will actually read your legal opinion and ask you they will read the legal opinion. They will read the answer that you gave in the oh my God, due diligence form, and they might have follow-up question, clarification, whether it's a little comics or things like this. You can clearly see that some exchanges ask you that information because it's part of a process. But do they even open the document that you send? Sometimes you wonder. But what they ask, I think what they ask is they kind of ask all the same things. What they do with it is sometimes a little bit different. And then where it really changed comes on the requirements and then price negotiation. But anyway, it does make sense that implicitly people feel like projects that are on specific exchanges, it gives them some sort of sense of approval or legitimacy, which is partially true because there has been some check. But obviously, if you look at some of the criteria and also how the criteria differs depending on the type of project that you are, it's only partially true.
Well,
It's only partially true.
yeah, partially true. And I think that leads very naturally to the next obvious thing, which is the requirements / negotiation with exchanges. Because end of the day, if you have a lot of capital floating around from the VCs, hundreds of millions of dollars, there's no problem getting listing on any exchanges, right? so let's get into the meaty stuff here, right?
So let's say you pass the due diligence and they're interested in listing you. So things have evolved a little bit, but what is important is always what is the cost to you as a project? How much will it cost to you? And so usually you have three different kind of costs. You will have the integration fee, which usually if you're a token that doesn't exist, but you will have a cost for the integration, which can be anywhere from 0 to hundreds of thousands. You will have a cost for the integration. You will have a cost for marketing. And a lot of exchange have, like in the past, that was more a few years ago, like 2 years ago, the trend was to say, we don't have any listing fees. We only take coins for marketing. But the thing is, from the project perspective, it doesn't matter what you call it and what pretty box you put it in. It's a cost to me. So usually you will have an integration or a listing cost, a marketing cost, and then you have the cost of market making, which is the third one, of liquidity provision. Because as soon as you go in the top 30 to 50 exchange, you will be asked to provide liquidity for your token, and you will not be listed. You will not be listed if you don't provide liquidity. So on the integration cost or listing cost, usually the listing cost for a token, or I would put listing and integration kind of as the same bucket. As a token, usually it's 0 or very low. As a EVM chain or EVM compatible chain, a bit less. More, and if you're a completely different new, it's usually the highest. Sometimes exchange, again, like I said, will say, we don't have any listing or integration fee, we just have a marketing fee. And so whatever the thing is, again, as a project, it doesn't matter. You're paying it. But usually listing and integration cost will be paid in stablecoin. Because if you think about it, this is to cover their cost to list you. So this is typically asked as a stable coin.
Yeah.
So not your token.
So Maud, so how do you get that stable coins, right? End of the day, you'll have to either have external capital or you'll end up selling your token somewhere else, right? And converting it to stables.
Yeah, exactly. But there's the stable component, and specifically if you have an integration need, they need to be able to cover their costs. So that's what I mean. It's like if you're just a token, they might waive the stable part of your list of your overall cost, because the integration cost they effectively have to compensate is pretty much zero.
Yeah.
Versus if you're a chain that like this, they need to pay like the whatever 2-3 weeks work of the developer. So they will ask for a stable portion. Then usually the marketing fee, typically this is the part that is in token or in coin. That's typically the part that is like this. In some cases, because they said they don't have a listing fee, they will have a marketing fee that is half stable, half token, because they basically just put the listing fee into the marketing bucket. But typically on the marketing side, this will be token, and this will be used for listing activities. So that can be airdrop to the user of their exchange that has the coin of the exchange. It can be competition, like trading competition for the first few weeks of the listing. And typically this marketing fee, the way it's presented to the project, you can never really know what really happens in the background. But this is redistributed to exchange users as they interact with the pair that you've listed. And so it goes all 100%, what usually they say. Again, there's literally no way to verify once you send them the token, what they do in the centralized exchange, can't know what they do, but it's supposed to be used for marketing activity that will generate attention and volume into your pair. And you have this, and then you have the liquidity requirements, which are really heavy. And I think this is something that as a project, especially if you're a small project, you have to take into account, because yes, it's not technically a fee that you pay, but it is still funds that are immobilized and at risk of being lost, because this is funds that you have to put on that exchange and then use a market maker or do it yourself, whatever, or use the exchange market maker to provide liquidity on your pair. And the liquidity requirements vary greatly depending on the exchange.
I want to get into market making because market making is, I think people know it's my pet topic. I love market making stuff. So on the exchange side, right? I know fees could vary anywhere between, 20,000 all the way to millions of dollars, right? Depending on the exchange you are going to be listing on. So what's been your experience? What is the highest people have asked you on X exchange?
So there are some, let's say, the cost of being listed is highly market dependent. So it's a little bit, so if you're getting listed, it's easier. Let's say, again, I'm speaking from the experience of Alephium, so it might not be true for a different type of project, but let's say exchanges are potentially more willing to list you at lower cost during a bear market. But at the same time, you're definitely, like we spoke about it before, if you're a complex protocol to integrate, you're more likely to be considered for listing during a bull market, because this is where you're able to show more traction. So it's a little bit, the complexity is exchange are more willing to list you because they are broadening their option in a bear market, because there's, like you said 11 million token died last year,
Yeah,
right?
that's-
So in bear markets, they have less projects that can afford to be listed, so they are a little bit wider in their nets. But at the same time, as a project, your traction during a bear market is, of course, not to the level of the bull market. So it's and we're talking by, sometimes it's divided by 2 or 3, the price of listing. We've had a case where over the course of several months, the listing price started at 50K, and 3 months later it was 160.
So this is
Because
bull market.
that was from end of bear market to bull market. So
Oh, I
within
see.
3 months, the listing price for a same exchange went from 50 to 160.
Why would it change though? Like the cost is the same.
Well, it's offer and demand.
I
Because the
see.
thing is, their bandwidth doesn't really grow as quickly as, the crypto market changed daily. So their bandwidth doesn't grow as fast. So they have
Right.
to prioritize. So they raise the price and people are willing to pay. So that's why it changes a lot. And so it changes a lot. And I do want to say there are certain exchange that have also tier depending on how your project rank in your price is going to be cheaper or more expensive. So depending on your traction, your metrics, your volume on other exchange, you will pay more or less. So there's also a range. But typically, I would say if you go top 10 exchange, and again, I'm talking from the perspective of a layer 1 that needs a proper full-on integration that is not an EVM copy. Price might be highly, highly different for different type of project, but I'd say top 10, you're already in the range of several 100,000 just for the exchange part. And I'm not talking about the liquidity you are obligated to provide. And that can go as high as several million. So we've had proposals that were several million uh, in cost. Not the one that was several millions wasn't actually necessarily stable.
Okay. The
Which
token.
to
Your
some
own
extent,
token.
yes. But usually, um, for the rest, it's several 100,000s, and it's pretty much 50-50. Pretty much 50-50. But we've had the experience of one that was in the million range, but that was full token. But it's still, again, depending on your tokenomics and depending on the price of your token at the time, this is extremely significant and you might still not be able to reasonably afford it.
Right.
So, and then again, then when you go, I would say 10 to 30, you will be more between 20,000 to 100. Let's say that would be the range. And then the rest can vary greatly, but it will be from a few thousand to this. It's broad spectrum, but that's kind of the range-ish.
Yeah. I mean, I've heard numbers as high as, 5 million, 8 million during the bull market on the top 5 exchanges, right? Like those are the numbers I know are definitely happens and happening. So 100,000 doesn't feel that bad if you're talking about top 10,
Yeah,
exchange.
top 10, 100,000, you'd be a few 100,000 unless you're very lucky. Again, it depends. Maybe if you're a token, like ERC20 token or something like that, might be possible. But at least for us, that wasn't our experience. I mean, I haven't checked. To be honest, I don't know the ranking of exchange right now. I think you might find a couple that are around the top 10 and sometimes in, sometimes out, that you will get a price range like this in the bear market. Again, in bear market, you usually have way more accessible pricing.
Sure.
More accessible pricing. And for the number that you said, like 5-10 million, I think it also depends what you put into it. So when I was talking about the several million, I was really not even talking about the liquidity
No.
provision that you have to put in. I was really talking about the broader listing cost without talking about market making. But it can go, it's pretty expensive. And I think that's something as project you have to budget. You have to budget. Because
Yeah.
for us, again, sorry, I know, just to say, for example, in the case of Alephium, we're proof of work. And the way our supply, tokenomics work means we don't have that much ALF available. And so, if a listing, even if a listing cost, depending on the price of the token, if it could be that a listing cost is like 60% of your entire available token that you have, and that's just one, and you're like, it just doesn't make sense. So, yeah, because you have one exchange that they will basically quantify your listing cost and will just say it's a percentage of your supply. But
Yeah.
depending on your tokenomics, you might not actually have that percentage of your supply. You might just not have it.
Yeah, yeah. I think I had literally same discussion with Kev, Junie from Kev, exactly same thing. Different issue on Casfa where, again, where are you going to get the supply from, right? And if people are holding these tokens, like these big whales that got in early on, you have the same challenge, which is, in the Lithium's case, you don't have the supply out. It's not been minted, right? But I think in Caspa's,
When you really, it won't go to us. It will go
yeah,
to the miner.
the
So we
miners,
have an allocation, but that allocation is fixed. And what we have is all we have and all we're gonna have. So, if one listing will cost you literally 60 to 80% of all that you have,
madness.
it's not viable.
No,
So
no.
it's
Yeah.
just not viable. But it's a lot of money that is either immobilized or potentially gone.
Yeah. Yeah, exactly. And end of the day, even if you decide to list, you'll have to sell the token on a different exchange, which obviously means you're dumping this, tokens in the market to then list on a different exchange, which counteracts the whole point of listing on an exchange, right?
Hopefully you have other ways than just dumping on exchange, and maybe you're lucky enough that you've done you know fundraising or pre-sale or things like this, and so you have a little bit of treasury into this. But obviously, if your treasury is exclusively your token, you need to have some treasury management mechanics where you can secure stable in a way that isn't dumping on the market, basically.
Yeah, yeah. I think, and that's really again comes down to smart management from I guess the operators, right? Likes of yourselves and other people, right? So I guess the other question I wanted to ask you on the exchange front before we move into market making is, do they consider the market cap?
They do. They do. They look at your market cap. They look at your FDV, the fully diluted value. They do look at your tokenomics, including your current numbers, and use this. I haven't had a case where the market cap was directly correlated to the fee you had to pay with not the market cap itself, the supply, yes, because again, there are some exchange that will charge you a percentage of your supply. Like that will be how they define the price. But the market cap being directly the source for the pricing that you pay, no. But the market cap being the reason why you get a yes or no for the listing, yes. That's part of the metrics that they look at. The market cap, the fully diluted value, the emission schedule. And again, this is the part where, as a project like Aletheum, proof of work project, which is not the norm, with a very, very slow emission schedule, it was really important. It was really important to explain the tokenomics very rapidly, because if you translate the number without actually understanding the context, you could easily get disqualified. And that's the part where you have you can see the difference between people who actually read the documents you provide or not, because you can see the ones who've opened them and not at all. That's one of the area, but it's also super important as a project. If you have tokenomics that kind of differ from the really, again, there's a million of projects and there are a million of them who have very, very similar tokenomics. If you have something that is different, you need to really quickly, because you have to think people go through many, many listings applications. So it needs to stand out, and you need to make it understandable with what matters to them very quickly, because otherwise you risk being dismissed wrongly because they've put your numbers in the context of that is completely different from yours. So it's quite important to contextualize your metrics if they are not, if they are to be understood in a different framework, basically. And I do, you were talking, you were mentioning the negotiation, and I do want to mention a point around contracts and things, and your power of negotiation. And so I would say you can somewhat negotiate listing price depending who you're talking to. This and your project, like if you're with listing manager, external listing manager, again, I think most of them are paid by commission, so they will try to get you. They will have a range that they're allowed to offer you, and they will try to get you at the highest range because it gets the higher commission. But they have a negotiation window, so you can kind of negotiate. Usually, the internal listing manager, they kind of just, they have a little bit less leeway, so they will just tell you things. But you can somewhat negotiate your listing cost, either by reducing it, by changing the portion of token, portion of stable. There's a little bit of wiggle. Part that is really, really difficult to negotiate on is contract terms. So usually the contract, you basically have to sign it as it is. And some of those contracts are really not great. But you don't really have a lot of wiggle room if they will not significantly amend their contract terms. And some of them, and also one part where they can delist you at any time for whatever reason they want, basically. And that's not something, that's one element that you can't really change in in the contract. It's just, they can just delist you at whatever, for whatever reason. Obviously they list reason, and it's not, they don't just, some do write it like this: we can do it whatever we want for whatever reason we want. Some of them make it nicer, but that's a reality. And also, for example, we've had the case, I don't know if I can mention that because it's too specific, but sometimes you will agree explicitly that you want to only be listed on spots, and you in the same way that you can't force an exchange to list you, you cannot stop them from listing you.
Yeah.
And some exchange, they will have then heavy liquidity requirements that are anchored into the contract, and some will go as far as prevent, not allowing you to withdraw assets from your market making account, which can be, again, so this is from experience. One exchange doesn't allow you, and it's in the contract. Theoretically, it's for only a short period of time. In practice, it's been years. They will not allow you to withdraw funds from your exchange. But it's a little bit complicated because if you're listed on multiple places and you're doing market making, a lot of times the market moves very quickly, and you sometimes have to rebalance between exchange. And that happens very frequently. But if you have one where you can't move funds, you just basically, if you become short one side, you just have to keep putting more, because you can always add more, but you can never rebalance the other with the extra you would have from there, which can be, but it's not the norm. Most will not have this. They will require that you maintain a certain amount of liquidity for a certain amount of time, but they won't go as far as locking your account. But some
Right.
some do.
Okay. So, given you've already moved us in the direction of market making, why don't we go deep into market making stuff? So exchanges, they have listing fee, integration fee, and of course they have their own reasoning behind it, right? Why they would or would not list you. And then on top, if they decide to list you, they do require you to, the top ones at least, they do require you to bring a market maker or some market making function, right? Because they want to have a deep liquid market. They don't want wide spreads, right? They don't want volatile markets, which would happen if there was no market making happening on an exchange, right? They want depth on the order book.
They want pretty order books, nice order books. So I would say the requirement for market making, it's not just the top 10. I think I think from top 30, I would say in most cases will ask, except exchange that are pretty small. Some of them will offer to be the market maker, like to you provide them the asset, they do it. Never done this option, but I have been offered. But basically, some will recommend market maker if you don't have one. And to some extent, they are tools where you like there's for example automated market making bots that you could connect, but you have to then you need to have the understanding, because having the competencies just to plug it into the exchange, that's relatively easy. I think I could probably do it. But then to set it up in a way that is good, you need to have some understanding of markets, how it works, because it's very, very easy to lose a lot of money doing market making.
Yeah, yeah,
Even that's why they are professional firm. Like it's a professional business. It's trading at the end of the day. It's trading with constraints, because
yes,
technically when you're market making, you're trading, but you have constraints that are sometimes very difficult to respect. And
yeah,
so,
yeah. I
and
mean,
so
they can,
it's
they
not
can
easy.
they can blow up, right? As you're saying, it's not easy because they're taking risk, and in most cases, not all, but they're trying to be delta neutral.
Yeah, exactly. And so you have and the different model have different, so they have constraints in when it comes to providing liquidity. Because again, as an exchange, usually exchange will have, as a project in their contract, exchange will have KPIs you have to respect when it comes to spread and order book depth. So then the market maker, they have to trade without losing your money and their money. I mean, losing your money, they care a little bit less, depend on your model, but
Yeah, they
without
care
losing
about their
your
own
money
money. Yeah,
and,
exactly.
and and not losing too much of yours while still meeting those requirements. And the crypto market is extremely volatile. And so when the market is when the market goes sideways, that's kind of the easiest to be dealt, like that's the easiest with quote marks, right?
Yes.
But when the market goes quickly up or quickly down, it's extremely expensive to maintain those liquidity KPI. And that's something people don't understand. And it depends. And it's true for both model. You have to think exchange wants you to have order book that are somewhat symmetric at all
Yep.
time. You
Yep.
want to have similar liquidity amount from your like from you, the one providing liquidity. They want you to provide symmetric liquidity pretty much at most times. That means that when the price is going up, your liquidity in token gets consumed very quickly, and you have to completely put more if you want to somewhat maintain that symmetry. And when the price goes down, it's the other side, so usually the stable side, that get consumed quickly. And if you want to maintain the liquidity symmetrical, you have to keep putting it. And so, and in the two models, either you have to provide that liquidity, or if you've gone through the option model, the market maker has to provide it, which is highly risky. And that's why, I mean, maybe that's why in that model, when you have big swings, a lot of market maker will usually pull out their liquidity, pull
Yes.
out
Yes. Thank
liquidity
you.
and the
Yes.
spread, because it's no longer your money, it's theirs.
Yes.
That's
Yes.
the difference between the two models. And I think maybe we can then talk about the model.
Can you please repeat this? Because I think people don't understand the risk appetite goes lower as the volatility goes higher, which is what we saw in October, also 10th of October, when the markets crashed. I think $20 billion got lost on that day. There's market makers pulled back on liquidity. And of course, we blame Binance for APIs and a lot of other things. But people forget that market makers are putting their own capital at risk, and they don't want to risk their capital.
Yeah, but I mean, to some extent with the option, they have converted some of the token in this, but it's also, I mean, they are a business, they have people that they have hired, they also have cost, right? They also need to not go bankrupt. And if they don't, and that's the thing is like, at the end of the day, when events like this happen, the money is lost somewhere. And depending on the model, the risk appetite does this, because when it goes down or up, your liquidity on one side or the other get consumed incredibly quickly. And either you have to put more or you have to pull out so you don't get executed, so your orders don't get executed. And I would say, usually if you go on the option model, they will be very risk adverse on the way down, because usually on option you give tokens. So maybe that's the right way to maybe explain those two different main model.
One thing, Maud, when you say option model, you mean options? You don't mean options, right? Not crypto options.
I mean call options.
Oh, you call option. So what is a call option in this case? Because you're not dealing with any, Greeks here. These are just call options, which is just a contract with the market maker.
So basically there's two, maybe taking a step back, there's two main models. So as a project, when you look to engage with a market maker, usually they will come to you with there's two big family of models. Some of them offer both, some of them specialize into one. You have the first one, which is retainer based. And it's broad. So obviously, between providers, you have slight change, but it's retainer based, which means that as a project, you pay a fixed monthly fee to the market maker to do market making. That fee is usually, it depends on the number of pair and the number on exchange you want them active. And that can start in the 1,000 and it can go, I've never had hundreds of thousands, but it's usually couple thousand for the really, really small market maker, but usually tens of thousands, like from 10,000 to more. It's in this range in average of that. That's the monthly fee you pay for the market maker to do the market making. There are some that are a couple thousand. What goes with the retainer base usually is that they trade with your asset. So you go to the exchange, you open an account with the exchange, and on that account, you will have to put liquidity that then the market maker will trade on your behalf on your account through APIs. That means that you as the project have to provide the market maker with the liquidity, which is usually 50-50 when you start. So let's say you have to provide 100,000 stable and $100,000 worth of your token on the exchange to the market maker, and then that market maker will deploy that liquidity in a way to respect the KPI that the exchange gave you. I do want to mention a number of range for people, because when you want a certain amount of liquidity to be deployed in a plus minus 10%, let's say you want 10K deployed on each side, so 20K total. The amount of liquidity you need to have on your accounts to be able to maintain this is usually 10 times that. Because again, you don't just provide orders at the minus 2%, you kind of have to do a symmetrical. So whatever you want between the plus minus 2%, a rule of thumb is like you need 10 times this to be able to do it really, really well. Of course, some people can do it with less, blah, 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 but that's kind of a rule of thumb that we've been given to be able to assess how much liquidity you have to put. So whatever people see in the minus plus 2%, to maintain it, you've actually deployed at least 10 times that into the exchange, because that's what is relatively safe. And usually, so they will trade on your account. With this model, the market maker gets paid by the retainer that you give them. Some market maker in this model will maybe lower the retainer, but they will do what they call profit sharing. Meaning if there's any profit that is made, they will either take the entirety of the profit or a portion of it. The reality is that if your goal as a project is to provide liquidity, if your main KPI is again depth and spread, you're not gonna make any profit. If anything, it's gonna cost you money, unless your market maker specifically has a strategy that optimizes for profits.
Right.
Yeah.
So I was going to add one point there, right? If there is a wallet that has a huge liquidity sitting there, just silently on the sidelines, right? And they would want to provide some liquidity for that token, right? They can earn a fee, which is by lending, they can actually earn a yield on top of that. So they lend it to a market maker and then they earn that yield. which is what very common in traditional markets, and obviously now becoming a big thing in crypto as well. So I think I just wanted to highlight that
That kind of goes with the call option model on the retainer. So that's the second model. On the retainer, sometimes they will do, to lower your retainer fee, they will do profit sharing, but again, providing liquidity, especially in a volatile market. If you manage to be neutral, like profit wise, you've done good. Because it's providing liquidity. It's kind of, if you do it really if your objective is just to provide liquidity and markets, it's usually at a cost. You have to optimize for profit and take benefit, and you can do a little bit of arbitrage if you're cross exchange. But honestly, if you optimize to really maintain those KPIs, usually if you manage to be neutral, you've done well. And so for the project, the benefit of the retainer-based model is that the assets stay with you, they stay on your account, but you have this fixed monthly cost that you have to pay, usually, and it's unstable. You pay this unstable, but you retain control of the asset, and you somewhat have to trust that the market maker is not gonna, with impermanent loss and shit like this, but you still retain control. You can see what they do because they usually trade on your accounts. But there's the cost of one, having to pay the recurring fee, and the cost of having those assets immobilized on the exchange, both sides. And again, then it's your decision when the market goes up or down. If you want them to stay, to continue to provide this liquidity, you would have to top up. You will have to top up tokens on the way up, and you will have to top up to stable on the way down if you want to maintain, and that will be your decision. And that will be eating at your treasury both ways. Again, you can also decide that when it's crazy, you also ask your market maker to pull out, but then obviously you have less, your market looks less nice, it's less good for your community, etc., etc. So I would say from a project perspective, it's a little bit less risky in the sense that the market maker has less incentive to be anything but market neutral. They get their money from the retainer that you pay. And then you have the second, which is the loan and the call option model, which there's different structure, but that's what we were talking. So another model is you will give a loan for a certain duration of time. That can be 1 month, 2 years. I've even seen shorter call option period, loan and call option period. You will loan them usually a significant amount of token. Here we are talking, depends on your number on exchange, but it's the dollar value is usually very high. You will loan it to them for a period, and they have the option to buy it at a certain price. They will have the call option with a strike price. And so the strike price is how they hedge the risk, usually. So the strike price, usually you will always kind of have one around the current price of the token. For some of them, it's the full option that has the strike price, the right to buy at the kind of the current price at the moment where you start the loan and the option. Some will have range, so you will loan them, let's say, 1 million token, because that's easy. You will loan them 1 million token, and out of this million, they will have the call option will have different strike price. You will have 200,000 kind of at the time of the beginning of the option. You will have 200,000, which is plus 5%, then plus 10%, and goes like this. And this is how they hedge. For a market maker, my understanding, but I could be wrong, the lower the strike price, the less risk for them. Like the closer the strike price is to the price at the start of the schedule, the better for them. A lot of them will just offer you this, and some that want to be more competitive, they will have
trenches, yeah, right.
They will have trenches. But then basically the way they earn money is by making profit by trading your token. And basically for them, they make, and obviously partially they also make money if the price of the token goes up. And because they have an option to buy it at the end of the call option, at the end of the loan, they have an option to buy it with, if the price has gone up, at a discount. And so for a project, then you have to balance different things. They will trade in a way that will make them money while trying to maintain the KPIs that you are bound to by the exchange. But obviously, rightfully so to some extent, they have to make money. They have to survive, right? They can't do it at a cost. So when the liquidity condition makes it very complicated to provide liquidity without losing money, they will typically pull back, because if they lose money, they are losing their own money. And so you have to, but for a project, you only have to provide tokens.
Maud, I mean, I'm aware of option market, traditional option market, right? But this call option you're mentioning is more of a bilateral contract between the project and the market maker, right? So what happens? So let's say a token is trading at $1 and you give them 1 million tokens of your project, right? Now they have a call option, then they can buy this token at $2 if the token gets to $2. Is that typically how it works?
Well, it's usually not this. So, I mean, it will be really rare that someone gives you a strike price that is 100% of the starting price. But let's say you give them 1 million token. When it starts, the price is at 1. The call option runs for 6 months, and they have a strike price. They have a portion at 1, a portion at 120, a portion at 130. At the end of the 6 months, if the price of the token, let's say they have 33% of the call option that has strike price of 1 third at 1.5, and 1/3 at 2. If at the end and the loan is for 6 months, at the end of the 6 months, the price of your token is 175. At the end of the loan, they have 2 options. That's the thing. Because the token is at 175, they can choose to give you back fully the loaning token. So you loan them 1 million token, they will give you back the 1 million token. But because the price of the token is higher than the strike price of 1 and the strike price of 1.5, they can also choose to give you back 1/3, so 333 like this in token, because that hasn't reached
so they earn portion of it, but not the whole thing.
Well, it depends how you see, but and then the 666 million, they can give you back in stablecoin at the dollar value. So but it's because the token is at 170, they basically bought the token from you, it's 175 at $1 and 150. So, but the thing is, they don't keep the tokens. That's the thing that is tricky. It's all about risk hedging. It's not that they sit for the 6 months with your tokens waiting to see at the end. They have to trade. I mean, some of them do that. Some of them do that. Some of them do that. They put the strike the call option. Then they just keep the loan and just wait to see if the price has gone up. If the price has gone up, they buy it at the discount and like this. But that's the part that is complicated. Loan model, because it's your money and your stuff, you can kind of in the contract force them to respect the KPIs. When you do the call option model, most market maker will not commit to KPIs. So you have to trust them that while they are trying to make money with the money you loan them, they are also they're also making sure that you respect your depth and volume requirements and liquidity requirements on the exchange. But this is where the call option is really tricky, because most contracts I've had one, and I've spoken to, 30 different market makers that really had a mechanism where you could fully stop the contract, cancel the loan, and cancel the option if you didn't meet the KPI, but most will not. So meaning once you've loaned it to them, you have to trust that they are actively trading on the exchange and that they will do everything they can to respect the exchange KPI. And there has been many cases of project, and we've experienced that, where we gave a loan, but actually they never deploy the funds. Like literally, they just keep the funds, wait for the option to expire, for the loan and the option to expire, and then if the price is lower than the strike price, they just give you back the token, and they basically done nothing wrong, it costed them nothing. And if the price has gone up, they make profit because of the difference. But this is really shady. And that's, but some will do this. If they think it's too risky to trade, they will just hold on to it and see what happens in the end.
Right. Well, that's a money glitch, no, right there.
But it's really rare. But then others will do a mix of this. They will trade when they are confident they can provide they will provide the liquidity and trade in a way that ensure those liquidity KPI when they are sure that they can do it in a way that doesn't cost them money. And when it's too risky, they will typically be very conservative with the liquidity that they provide, and therefore maybe not meet the KPI. And so that's the trade-off of both approach. As a project, the call option is attractive because you don't have the recurring stable cost plus the cost of locking some of that stable liquidity and maintaining it through times. But at the same time, this is much more a trust-based relationship because you're trusting the market maker to balance their incentive and their risk with your requirement. And so and a good market maker will do the best they can to, make sure they earn the money that they deserve for the service while still meeting your liquidity requirements and balance out that risk with your constraints. There was in the past a lot of market maker scandal. Usually that was with the option model. That was usually there because, again, that's where you give a lot of power to the market maker over your liquidity without any remediation mechanism. So someone that is malintentioned has a lot more potential for harm than on the other model, because it's on your account. If you see they start doing something shady, you just cut the access, right?
Yeah.
And you can stop it if you want to. You can stop it, but it's super costly for a project. And again, when you do the call option model, what you have to realize is for the market maker to start providing liquidity, they will have to sell your token. And if they tell you, no, but don't worry, we will use the USDT from our treasury, they might do a little bit, but not enough. If they want to maintain the exchange KPI, they kind of have to be, balanced on each side. So they will need a good portion of stable as well. So even if they decide if they are really rich and really have a lot of money and treasury and are really not risk adverse, they might use some of their own treasury to provide the USD, the stable side. But honestly, most won't, or will only do it in a small capacity, because in terms of risk, that's crazy. Like in their position, you wouldn't do it. You wouldn't do it in their position.
No one would do that. But look, it's been amazing to discuss these sort of taboo topics that not a lot of people really talking about it in detail. So all right, let me ask you this last wrap-up question, right? So we've gone through exchanges, we've gone through market making. Now the project is live on an exchange, right? Let's call it tier 1 exchange, right? What are the KPIs that you as a project now tracking?
I mean, so I think it depends. I think there was a time 2 cycles ago where an exchange listing was a factor of growth in most aspects of your token. But that was at a time where there was a couple thousands of projects.
Right.
I think in the recent years, and I've seen, I don't have the numbers there, but I've seen them float around in Twitter. For most projects, a tier 1 listing usually doesn't have a positive impact on the various metrics that you have, especially the first few months. especially the first few months, because yes, depending on which exchange you're talking about, you're available to more user base. But usually it's what has been more observed the past cycle is usually a tier one listing is usually for the first few months. You might have the first week an initial positive effect, but usually then for the next 6 months it's usually a more negative effect, both in many metrics. So I think if you track certain metrics, you won't see necessarily a positive impact. I think the importance, obviously, volume is very important. Like once you're listed, volume is important because this is also something that that tells you the volume on that exchange as well as the volume on the other exchange, because then you can see are you getting new people. It's very difficult to get metrics from exchange around how many of their user are actually trading your pair. So I haven't received that information from exchange, but if some of them would be willing to share it, I think as a project, it would be interesting to know how many people are effectively trading. Once you have a volume, it's important to have it in context of how many people are actually trading. Is it like a few people trading high volume? Is it a lot of people trading low volume? That would be interesting. But volume is important because it tells you information, and it's also maintaining that volume is usually a requirement to stay listed. I think another metric that you should look at, it depends what kind of project that you are. But for example, in our case, we would be looking at all of the other metrics outside of the exchange, like wallet download, on-chain data, to see if did this listing bring anything, did it trickle out from there to your ecosystem? Did it bring more users covering your project beyond the speculation side and actually looking, was this really a gateway for them to use your project, discover your ecosystem and things like this? Or was it just a speculative trading interest? I would be looking at that as well. As we were talking about volume and market maker, it's less true now because now exchange watch for wash trading. But several years ago, a lot of market makers doing wash trading to artificially inflate volume KPIs. Now most exchange will blacklist you if you do this. Some of them will let you because it's good for them. Some of them won't let you do it, but they would do it.
Yeah, they themselves will do it. Yeah.
They will do it, but you will not be able to do it. But basically just people trading, like your market maker trading with himself between two different accounts to just have a super high volume. But actually there's no users, just two people exchanging the same money back and forth. Because to combat this, exchanges usually have trading fees. But, and I would say the bigger exchange usually lower their trading fees, but they don't put them to zero. Whereas I think in smaller exchange, we had sometimes zero trading fee. So trading fee are a way to combat wash trading because every time you trade, you pay a fee. As a project, a market maker that offers you says, some of them will say zero fee. We do profit sharing. That profit comes from somewhere. Comes from your markets, and that will basically comes from your community, right? Comes from every other market participant, and so it might sound good, but usually in most cases that implies a market that is a bit predatory toward your community, because money doesn't come from nowhere.